In 2005, a company that sold about 80,000 cars a year decided to buy a company that sold more than 5 million. Porsche wanted Volkswagen, and it wanted more than a partnership or a supply deal. It wanted control. Fast forward to today, and Volkswagen owns Porsche outright. Every factory, every badge, every share. The small sports car maker that tried to swallow one of the largest automakers on the planet ended up being swallowed instead. That reversal alone would make a good story, but here's the detail that makes it a strange one. For a few weeks in October of 2008, in the middle of the worst financial crisis since the Great Depression, Porsche's failed takeover attempt briefly made Volkswagen the single most valuable listed company on Earth, bigger than ExxonMobil, bigger than every bank left standing. Volkswagen's shares went from around €200 to over €1,000 in 2 trading days. Hedge funds that bet against the stock lost an estimated $30 billion in a matter of days, more than double what short sellers would lose more than a decade later in the GameStop squeeze that made headlines around the world. So how does a company almost buy something 40 times its own size, trigger one of the biggest short squeezes in financial history along the way, and still end up losing itself completely? And why, more than 15 years later, is that failed deal still the reason one family quietly controls both companies today? That's what this video is about. To understand how this happened, you have to go back further than 2005. You have to go back to a single family and a car that was never supposed to make anyone rich. In the 1930s, the German government under Adolf Hitler commissioned an engineer named Ferdinand Porsche to design an affordable car for ordinary families. What he built became the Volkswagen Beetle, one of the best-selling vehicles in automotive history. Porsche didn't own Volkswagen, he designed it. But the relationship between his name and that car never really ended. After the war, Ferdinand's son Ferry took the family business in a different direction. Working out of a converted sawmill in Austria, he built a small, lightweight sports car using mechanical parts borrowed from the Beetle itself. That car became the Porsche 356. A few years later, it evolved into the 911, the car that would define the brand for the next 70 years. By the 1970s and 1980s, Porsche had built something money alone couldn't buy, a racing pedigree. The 911 and its descendants dominated endurance racing at Le Mans for decades, and that motorsport credibility fed directly into the showroom, letting Porsche charge premium prices for cars built in comparatively tiny numbers. This was a company that had turned scarcity and engineering obsession into its entire identity. Meanwhile, Ferdinand's daughter Louise had married a man named Anton Piech. Their son, Ferdinand Piech, grew up inside the family business as an engineer, not an executive. He designed the engines behind some of Porsche's most famous racing cars, including the legendary 917. He later moved to Audi, where he championed the Quattro all-wheel drive system that transformed the brand's reputation on rally circuits and showroom floors alike. By the time he crossed over to run Volkswagen itself, Piech already had a reputation as one of the most gifted and most ruthless engineers in the industry. By 1993, Piech was Volkswagen's chief executive. He restructured the company around shared engineering platforms, a move that let VW, Audi and Skoda split components across models and slash costs at massive scale. It turned Volkswagen into one of the largest industrial companies in Europe. Keep that detail in mind. One branch of the same family was now running the giant. The other branch was running the boutique. And for a while, that arrangement worked fine. Quick reminder before we go further. If stories like this keep you watching until the very end, the subscribe button costs nothing, and it tells the channel to keep making them. By the mid-2000s, Porsche was arguably the most profitable car company on the planet, measured per vehicle sold. Under chief executive Wendelin Wiedeking, the company had done something almost nobody expected. It took its lean, Japanese-influenced manufacturing principles and applied them to a completely different kind of vehicle. The Cayenne, a luxury SUV built on a shared platform with the Volkswagen Touareg. Purists hated it. Customers didn't. The Cayenne alone pushed Porsche's annual sales past 6 figures for the first time in its history, and the profit margins on every unit were enormous. Wiedeking had spent years before that stripping inefficiency out of Porsche's factories, borrowing production techniques directly from Toyota and cutting the company's workforce and supplier costs at a time when most German manufacturers considered that approach unthinkable. By the mid-2000s, the results were undeniable. Analysts were calling Porsche the most profitable car company in the world on a per-vehicle basis, ahead of manufacturers selling 10 times as many units. Volkswagen, by contrast, was the opposite kind of business. It was massive, unionized, partly owned by the German state of Lower Saxony, and answerable to a supervisory board where Labour had real power. Where Porsche was lean and nimble, Volkswagen was an industrial empire with 10 brands, hundreds of thousands of employees, and a bureaucracy to match. Two cousins, two philosophies, two companies of wildly different size, and one of them was about to try something nobody in the auto industry saw coming. Then, in 2005, something changed. That year, Porsche quietly began buying shares of Volkswagen. On the surface, the reasoning sounded defensive. Porsche depended on VW for components, engineering, and manufacturing capacity. If a foreign raider ever took over Volkswagen, Porsche's own supply chain could be at risk. Buying a protective stake, Wiedeking argued, was simply good business. The stake grew in stages, reaching 20% by 2006 and 27% by early 2007. Each disclosure fed speculation that a full takeover attempt was coming, and each time Porsche pushed back on the rumours. At one point, the company argued publicly that a run at 75% ownership overlooked a basic reality, that the state of Lower Saxony already controlled 20% of Volkswagen and would never sell. By March of 2008, Porsche had disclosed a 31% stake in Volkswagen. Publicly, the company still insisted it had no plans to go further. Privately, something else was happening. Porsche wasn't just buying shares outright. It was accumulating cash-settled options, financial instruments that gave it the economic exposure of owning VW stock without immediately showing up as a disclosed shareholding. It was a legal maneuver, but a deliberately opaque one, and it let Porsche build a much larger position than the market realised. To fund all of this, Porsche was borrowing heavily. Billions of euros in debt stacked up to finance a stake in a company nearly 40 times its size. That wasn't the only problem building underneath the surface. Because Volkswagen's freely tradable shares were scarce, thanks to Porsche and the state of Lower Saxony both sitting on large blocks, hedge funds looked at VW's stock price. They concluded it was wildly overvalued relative to a company with a shrinking public float. They piled into short positions, betting the stock had to fall. By some estimates, more than 12% of VW's entire share count was sold short, heading into the fall of 2008. Then, on a Sunday night in October, Porsche pulled the trigger. On October 26, 2008, Porsche announced what the market had feared and denied in equal measure. It now controlled 74.1% of Volkswagen, through a combination of direct shares and those cash-settled options. Porsche's statement pointed to what it called dramatic distortions on the financial markets as the reason for coming forward. Add in Lower Saxony's 20% stake and barely 6% of Volkswagen's shares were left in public hands. The math turned violent almost instantly. Hedge funds holding short positions needed to buy back roughly 12 to 13% of VW's shares to close them out. There weren't enough shares to buy. Over 2 trading days, Volkswagen's stock price rocketed from around €200 to more than €1,000. For a few hours on October 28th, Volkswagen was, on paper, the most valuable publicly traded company in the world, briefly surpassing ExxonMobil. Short sellers are estimated to have lost $30 billion almost overnight. One market analyst at the time called it simply the mother of all short squeezes. Trading desks across London and New York spent that week scrambling to understand how a mid-sized German car maker had just cornered one of the most liquid stock markets on the planet. The fallout wasn't just financial. German regulators opened an investigation into whether Porsche's disclosures amounted to market manipulation. Hedge funds that lost money considered lawsuits. Years later, academic researchers publishing in the Journal of Financial Economics went further, arguing the entire sequence of denials and disclosures looked less like ordinary corporate manoeuvring and more like a calculated plan to rescue Porsche from a debt problem nobody outside the company could yet see. On paper, this looked like the greatest trade in automotive history. It wasn't. Because underneath the celebration, Porsche was sitting on a mountain of debt it had built to fund the very stake that just made headlines, and the financial system it needed to refinance that debt was collapsing in real time. Lehman Brothers had failed barely 6 weeks earlier. Credit markets around the world had effectively frozen. And Porsche, it turned out, owed somewhere close to €9 billion in net debt, borrowed specifically to pursue a 75% stake in Volkswagen so it could formally take over the company. Banks that had happily financed the build-up in 2007 wanted nothing to do with rolling over that debt in the winter of 2008. Wiedeking went looking for help. He applied for a state-backed loan of nearly €2 billion through Germany's development bank, the same kind of emergency lifeline being extended to struggling companies across the country. Berlin said no. Wiedeking, who had once publicly argued that state aid and luxury car making didn't mix, later complained about what he called draconian banks suddenly refusing to extend credit. The irony wasn't lost on anyone watching. With no domestic rescue available, Porsche turned abroad, opening talks with the Qatar Investment Authority about a capital injection large enough to plug the hole. Volkswagen, sensing weakness, made its own move. It offered to buy a stake of nearly 50% directly in Porsche's sports car business, a proposal that would have started reversing the entire power structure Wiedeking had spent 4 years building. Porsche flatly rejected it, with a spokesman calling the offer not a viable option and noting that VW would need to borrow more than €10 billion just to fund it. Wiedeking still wanted the Qatar route and a deal that let his family keep the upper hand. That wasn't the only problem. Germany's political establishment had its own opinion. Christian Wolff, then Premier of Lower Saxony, and a Volkswagen supervisory board member himself, moved to block a preliminary Qatar agreement, reportedly with Chancellor Angela Merkel's backing. And this is where the story gets stranger, because sitting on Volkswagen's own supervisory board, watching all of this unfold, was Ferdinand Piech. Remember him? The cousin, the one running the giant instead of the boutique. As Porsche's debt crisis deepened through the spring of 2009, Piech began publicly voicing doubts about Wiedeking's leadership and Porsche's handling of its own finances. Behind closed doors, he reportedly worked to steer Qatar's money toward Volkswagen instead of toward his own family's holding company. Family loyalty, it turned out, had limits once €9 billion of debt entered the picture. Only months earlier, German newspapers had treated Wiedeking as a national business hero, the small-town executive who had outmaneuvered Wall Street and Wolfsburg in the same year. Now the same papers were asking how he had nearly bankrupted the company he'd spent 15 years building. By July of 2009, Wiedeking's position was untenable. He resigned as chief executive of Porsche, walking away with a severance package reported at roughly €50 million, half of which he directed to charity. The man who had built Porsche into the most profitable car maker on the planet, then nearly bought Volkswagen outright, was gone in less than a year. What happened next moved fast, and it moved in exactly the opposite direction from where this story started. Porsche's board, facing a debt load it had no way to refinance on its own, approved talks to combine with Volkswagen, not the other way around. By December 2009, Volkswagen had taken an initial stake in Porsche's sports car business. Untangling the rest of it, the cross-shareholdings, the debt, the legal structure, took nearly 3 more years. In August of 2012, Volkswagen completed the purchase, paying roughly €4.5 billion for the remaining slice it didn't already own. Porsche AG, the company that had tried to take over Volkswagen 4 years earlier, was now a wholly owned subsidiary of it. One industry analyst summed up what had just happened in a single word. He called Ferdinand Piech simply the kingmaker. But the Porsche and Piech families didn't walk away empty-handed. Far from it. As part of the untangling, the family's holding company, Porsche SE, retained a controlling voting stake in Volkswagen itself, propped up with fresh capital from Qatar to help clear the debt. The family had lost their sports car company. In exchange, they ended up in permanent control of the much larger empire they had originally set out to conquer. So what actually went wrong, and what does it teach us? It came down to 3 mistakes. First, Porsche financed an audacious bet with debt instead of capital it could absorb losses on, which meant a market downturn didn't just hurt the trade, it threatened the entire company's survival. A cash-rich raider can survive a bad quarter. A leveraged one cannot. Second, The very secrecy that made the option strategy so devastating to short sellers also made Porsche's own balance sheet unreadable to the banks it would later need for a bailout. The opacity that won the battle lost the war, because the same silence that hid the position from short sellers also hid the risk from the lenders Porsche needed most. Third, and maybe most costly of all, control of a public company and control of a family's fortune turned out to be two different things. Porsche lost the first. The Porsche Piech family never lost the second, because Piech was willing to prioritize the family's overall position over his own cousin's company. In a family business built across 3 generations, the company was always negotiable. The family's control was not. Here's the part that makes this story worth revisiting today. In September of 2022, Volkswagen floated 25% of Porsche AG's preference shares on the Frankfurt Stock Exchange, valuing the sports car brand at somewhere around $75 billion, one of the largest EPOs in European history. It looked like vindication. The brand Wiedeking built was now a standalone financial star again, even while sitting inside Volkswagen's structure. Then came 2025. Porsche's push into electric vehicles ran straight into weak demand, a China market where local brands are now winning on both price and technology, and new American tariffs. The company booked nearly €4 billion in write-downs tied to reversing its own EV strategy. Operating profit collapsed by more than 90% in a single year. Porsche's stock lost over 30% of its value, and the company was dropped from Germany's blue-chip DAX index entirely. Volkswagen Group, still controlled by the same family holding company, born out of the 2009 rescue, announced plans to cut around 50,000 jobs across Germany by 2030, with roughly 3,900 of those cuts landing at Porsche itself. Oliver Blume, who had run Porsche AG for a decade through the EPO and the EV pivot, stepped back at the end of 2025 to focus solely on leading Volkswagen Group. A new chief executive, Michael Leiters, took over Porsche AG at the start of 2026, inheriting a strategic reset his predecessor never saw coming. Today, Volkswagen owns 75% of Porsche AG. Porsche SE, the family vehicle, holds the rest as a blocking minority, plus a majority of the voting rights in Volkswagen itself. It's the same family running the same circular structure born from a takeover that failed spectacularly in 2009, and it's still being tested, this time by a different kind of miscalculation entirely. Porsche tried to buy Volkswagen and lost itself in the attempt. 17 years later, the family that made that bet is still running both companies, still absorbing the consequences of a different bet gone wrong. The names on the buildings in Stuttgart and Wolfsburg never changed. The debt did, the leadership did, and the balance of power flipped entirely. Twice. Ownership, it turns out, was never really the hard part. Timing it against a crisis you don't control always was. If you want to see another family that has quietly run a global car empire from behind the scenes for generations, the story of the Quandt family and BMW is next, and in some ways, it's even stranger than this one. One industrialist built his fortune on batteries and wartime manufacturing, rescued BMW from a near-total collapse in 1959, and today his children still control nearly half of the company's shares from a seat on its supervisory board. That story is coming up next.